My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I hate that we have to spend so much attention to the Federal Reserve. We know it's possible to make money in the market with or without the Fed on our side, but it sure is easier when the Fed's down and out of the picture, and they're not. Yep, we didn't get that today. We got a Fed that raised rates another quarter of a point and then said it would wait to see what happens and take action if needed. It seemed benign initially, but then we got a late afternoon sell-off with the Dow finishing off 270 points, the S&P sinking 0.7%, and the Nasdaq declining 0.46%. Powell's now raised rates an astonishing 5% in 14 months. It's the fastest set of increases we've ever seen. If you can get 5% risk-free, though, who needs the stock market? Well, we're discovering it's not as many people as we thought. It's really hard to pull your capital out of a safe zone like 5%. Very easy to abandon the market entirely where you can get a very solid return from CDs or short-term treasuries. And you know what? I've got no problem with putting a ton of cash in the sidelines. It could make a ton of sense given the gauntlet I am predicting we must go through before we want to commit new capital to this market. Powell also made it clear that he won't let up in his war against inflation. He mentioned the Fed's 2% inflation target endlessly, and we're nowhere near that. Long-term, that's good news for growth stocks because growth stocks flourish in a low inflation environment. Although short-term, it can hurt it can hurt them, and the names don't respond well to rate hikes. So as much as you got a green light to go into cash, you also get a green light eventually to start buying growth stocks as the hurdles. Apple's quarter, which you know I'm not that confident about, the employment number, and the debt ceiling crisis, they all fall into the rearview mirror. Once that happens, well, that'll be good news. And right now we've got one down and three more to go. The only reason anyone's even willing to consider buying growth stocks is because the Fed made it clear they're no longer going to keep hitting us with a series of lockstep rate increases. Powell's now data dependent. He wants to wait and see what happens. If the economy stays too hot, he's going to whack us with higher rates. But if it keeps cooling down, hey, maybe he does nothing. In the end, Powell's trying to thread the needle. He wants to get back down to 2% inflation, but not at all costs, and I like that. The most important thing that came out of the Fed meeting, though, is the very fact that it ended, giving us a chance to catch our breath and get ready for more pain, which I've been telling you was going to happen. Now, I'm not a Fed watcher. I'm someone who loves a good steeplechase, and the market initially went over this hurdle with a plum, mostly because the Fed didn't commit to anything. That's great news, although it didn't stop the market from rolling over near the very end of the day, but that wasn't really all the Fed. So I think the Fed's either done tightening or almost done tightening, depending on how the data shakes out. However, I don't think they'll be cutting rates anytime soon, certainly not this year. So those who believe Powell will throw us a bone are bound to be disappointed. We're not going to have that happen even this year, I think. But if you're willing to be patient, what kinds of stocks should you be looking at? Well, you can certainly buy the stocks that historically do well when we go into recession, because that's what so many people heard today. That's their interpretation of what the Fed just told us. You know, oddly, you can buy the housing and housing-related stocks because longer-term interest rates actually went down today, and that's what matters for mortgage rates. I know it's counterintuitive to buy home builders and the recession stocks at the same time. That almost never makes sense historically, but this is a weird market where history has meant very little. And eventually, but not yet, and certainly not before we see Apple, you can buy tech because they do well when inflation's under control and the Fed's going toward its 2% inflation target and succeeds. Homes, consumer packaged goods, and ultimately tech? Amazing. I've never seen that mosaic before. But then again, we've never seen the Fed take rates from 0 to 5% overnight. Notice, though, I didn't say you can buy the financials. That group is horrible. That's because the Fed seemed to ignore the current mini banking crisis. They only focused on the one to happen in March. I couldn't believe Powell ignored the failure of the First Republic earlier this week, especially since we don't have anything in place for the other branches of government to prevent more bank runs. Just look at PacWest and Western Alliance getting killed in after-hours trading, down hideous, terrifying amounts even. It was negligent not to mention what's going to happen because we got to put pressure on the FDIC to raise insurance or a lot more banks are going to go. The regional bank weakness and perhaps wipeouts will soon reverberate through the entire economy, because when banks are struggling, it's much harder to borrow money. I was stunned that Powell didn't acknowledge this. You can bet there are tons of people who banked the First Republic, and they're not going to get any sweetheart loans anymore, zero-interest loans, not from First Republic's new owner, J.P. Morgan. What we really don't want to see here are further bank runs caused simply by the massive declines in their stocks, like we got from PacWest, which has been cut in half after hours because it said it was weighing its options, which has become shorthand for waving a white flag and saying, we're done. Lots of perfectly fine banks like Key or Comerica or Huntington, really necessary banks to the American economy, have seen their stocks get crushed by short sellers, betting they can crack these helpless creatures, and it's been working. It's become a vicious cycle, people. The shorts push down the regional bank ETF, which then takes down all of their individual stocks that are in the ETF. Once the stocks go low enough, it causes people to lose faith and scares away more depositors, which in turn gives the short sellers even more ammunition. Powell didn't talk about the need to insure deposits to these banks. He just kept saying the banking system's sound. Great if true. But unfortunately, the banking system is only as sound as the psyche of the larger depositors. If they're worried because of the declines in the bank stocks, they'll take anything north of the FDIC's $250,000 deposit cap and send it elsewhere. That hasn't been addressed. But as I've said, it's causing banks to be more cautious with their lending to the point where it's really equal to another 100 basis points of worth of rate hikes. The bank system isn't sound. We just have some very sound big banks. The collapse of the banks we have seen amount, I think, to about another 100 basis points. So now what do we have? We have 600 basis points of hikes, not just the 500 that Powell mentioned. What does this mean to you and your portfolio? It means you've got every reason to want to sell, and ring the register. Park your money in cash. Nothing wrong with cash. We've been raising it for the charitable trust, just not enough. Unlike today's sellers, we're using cash because we want to we're raising cash because we want to buy our favorite stocks, but at lower levels. I think the gauntlet will send the whole market lower, especially the debt ceiling crisis. I recommended buying into the teeth of that sell-off, but not yet. The bottom line, raise some cash as we go through the gauntlet. Keep your bat on the shoulder, but recognize that we're going to have some viable groups soon enough. We just can't pull the trigger until the whole market gets oversold and we're further along in the steeplechase. Right now, it's still 1 down, 3 to go. But with Apple having run big into tomorrow's quarter, which I think was a big mistake and almost always goes down when it reports, and with the pulverizing of so many regional banks after the bell because of PacWest problems, all I can say is patience and cash are the true virtues at this moment. Brian in Virginia. Brian.
Hi, Jim. Thanks for taking my call. My question today is about Dominion Resources. Been a direct purchase plan program with it for like 30 years, and it's always done well by me, and now it's really suffered over the past year. Should I keep buying? Should I sell it?
Yes, you should. I think Dominion, the sell-off is overdone there. I think that it's just right now, a lot of people just don't understand what's quite frankly happening with it. It's got to be, I think they need a big analyst day and flush things out because it has been far worse than most of the utility companies I follow. Dustin in Oklahoma. Dustin.
Booyah, Jimbo. How you doing, sir?
I'm doing well, thank you. How about you?
I'm doing fantastic. It's good to talk to you again. I'm a long-time, many-time Charter Club member.
Excellent.
And I love you, man. The stock I'm calling about today is a holding I've held for quite some time in the club. I've gone through the lows of, getting cut in half and then came back up. And with the numbers being reported in the last few days with MGM and Macau, and with all my friends that I used to live in Las Vegas, seeing all the results going on in Las Vegas, I'm really interested in what your thoughts are about Wynn moving forward.
I like Wynn very much. I think that Wynn's a play on Macau, too. It's one of our better stocks. We held on to it. Thank you for saying nice things about the club. We had some tough ones today, too, though. I don't want to just stay with the good ones. Let's go to Roland in Louisiana. Roland.
Jim, how you doing, man?
I'm doing well, Roland. How about you?
I'm excited, man. It's my first time calling, man, from New Orleans.
Excellent. Thank you for calling.
Now, let me tell you, that was a stock that you had brought up a while back, and I really did a lot of investigating on that particular stock. And it was Palo Alto Networks, which I believe is the #1 cloud-based security company in the world. And
I think you're right, Roland. But remember, it's a tech stock. I don't expect Apple to do that well tomorrow because the stock ran. And I think that you can buy Palo Alto lower. We've got some. We want to get bigger in it. But I think it can go down more. Even though the company's good, it doesn't mean the stock can't go down. All right, now we got some eventual viable groups thanks to the Fed, but you can't pull the trigger yet until we go through 3 more hurdles in this endless and difficult steeplechase. On Mad Money tonight, Wingstop scoring after hours. I'm finding out the stock could continue to fly with the company's top brass. Then last year, Bausch Health spun off Bausch & Lomb into an independent company. I'm digging into the story with the company's CEO and recapping his first 50 days on the job. And Brinker International, which is the company behind Chili's and Maggiano's, fell after its report. So are investors getting the opportunity to take a bite out of it? Well, maybe after the gauntlet, they sure are. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.